InFi, Episode 7.
Welcome to InFi, the future of finance, hosted by American economist and author Dr. Robert Murphy. Each week, tune in for dynamic discussions with business pioneers about emerging trends in finance, life insurance, asset management, technology, and more. Now, let's talk the future of finance.
Hey, everybody, welcome back to the InFi podcast. For today's episode, I thought we would return to one of our favorite topics here at InFi, the economics of life insurance. So specifically, what I would like to do is unpack a very popular demonstration that you'll see in this space, namely when people say, oh, rather than getting a whole life policy, you should, quote, buy term and invest the difference. So why don't we, just to motivate things and to show I'm not attacking a straw man, let's go ahead and play a clip from Dave Ramsey's show just to hear. And this is, I didn't have to go searching high and low for this. This is the kind of thing he says all the time on his program, to the type of case he would make to explain why it is that you would be foolish to buy a whole life or, in general, permanent or cash value life insurance. So we'll get and roll that clip.
I was just tuning into your show not too long ago, and you were speaking about life insurance and how whole life is absolute junk.
Mm-hmm.
I never understood how or why that is necessary or true.
Okay.
I believed that whole life was better, and I started out seeking whole life, and so I ended up buying a policy for each of my 3 kids, and I have a universal policy for my mom,
Mm-hmm.
and the policies I have for my 3 kids, one is it's called a 10-pay,
Mm-hmm.
where you pay it for 10 years and it's paid up.
Yep.
And so I did that with my oldest daughter, and she has a policy. It's only $15,000 or $20,000 for hers.
Yeah. It's a standard kid policy. Yeah. The reason you believe this is what you've been sold. Okay. But let's walk through it for a minute. Okay. There's 2 kinds of insurance, as you mentioned. There's cash value insurance and there's term insurance. All right. Term insurance on average runs about 1/20th the cost of whole life or cash value insurance. In other words, you could have bought that same policy. Instead of spending $100, you'd buy a month or whatever it was. Let's use 100 to be an example. Then you'd spend $5 a month. So what does the extra $95 that you're going to, what does it go to? Okay. Well, it goes to build up a savings account inside the policy called cash value. Does that sound familiar to you?
Yes.
And that's why you bought it, because you thought, hey, it builds up a cash value. That's awesome. All right. And here's the thing. The problem is not that. The problem is that the rules or the guidelines that happen to what happens to the money in the savings account. On average, it's making about 1 to 1.5%. Horrible rate of return. Number one. Number two, if you want your money out of the policy, you either have to cancel the policy or you have to borrow your own money. Now, you put the money in there. You put the money in there, but when you take it out on a loan, you pay them interest to borrow your money.
Mm-hmm.
Well, that's kind of stupid.
Yeah.
You wouldn't take money out of a savings account and borrow it from the bank, and give them interest to borrow your own money back. Not if you're smart anyway. And then, but the worst part of, the fees are really high. The cash value doesn't build up for many, many years, but after 2 or 3 years, finally, it does start building up. So it's really heavy loaded fees on the front end. And then the worst part, though, is this. You got a $15,000 policy on this kid. What's the cash value in one of those? As an example.
Oh,
I'm sorry?
I don't even know what the cash value in any of them are.
I'll give you a guess. I'll give you a guess. Let's say it's $5,000. If you close the policy, that they'd get $5,000. All right. And we've just established that you've paid extra for that $5,000 to be in that policy. So you have a savings account inside that policy, right?
Right.
You paid a lot more for these policies than you would have for the same amount of term insurance. A lot more. Now, so that $5,000 that's in there, it's your money. The problem is this. If the person that the insurance is on dies, They don't pay the $15,000 insurance plus your savings. They pay the $15,000 insurance. What happened to your savings?
Oh.
It's gone.
Oh.
And the only way you get...
thought of that.
Okay, and there you have it. So let me, before diving into the analysis, and by the way, big picture, what I'm going to do in this episode. So I'm an economist, friendly neighborhood economist. I'm here to help. My goal for today is not to convince you that you need to go buy a whole life policy. And my goal is not to say term policies are bad. Rather, what I'm doing is I'm going to show you if you actually wanted to be fair and do a serious apples to apples comparison of two possible strategies, you would want to take into account the sorts of things I'm going to show you in today's episode of InFi. That's what I'm trying to do. All right. So full disclosure, I have a decade plus experience in writing on the economics of whole life insurance. And I helped develop a training program for financial professionals. And now here at Infineo, we set people up, households and business owners, with tailored, customized whole life insurance policies all the time. So I clearly am a fan of that way of doing things, but I can be fair, and I'm going to just go ahead and show you the pros and cons, or the types of considerations that you would want to go through when assessing two possible strategies. Okay? And it's not surprising that I'm a fan of the whole life approach, because I realize how this standard, oh, that's crazy, you should just buy term and invest the difference. I see all the shortcomings of that type of critique. And just personal background, when I first got into this space, that was one of the things that reassured me that I should continue to investigate, is because early on, when I was being introduced to the possibility of using a whole life insurance policy, not merely for the death benefit, but also for what they call the living benefits. Here at Infineo, we describe it as using it as a cash management vehicle, that I encountered resistance. And I went through and I just started looking at the main objections that I would see online or on popular shows like Susie Orman or Dave Ramsey, and seeing how ill-informed those critiques were. That made me continue pursuing it. So obviously, just because somebody is a critic of something and uses invalid objections against it, doesn't mean the original thing is actually a good idea, right? The critics could be wrong, or could be right, but for the wrong reasons, put it that way. Well, if they're listing objections, maybe their objections are silly, but maybe their gut is still right. Okay, that's possible. But I'm just saying, early on, I realized in my own personal discovery and odyssey in this area that no, a lot of these people, they really don't know what they're talking about. And so when you start unpacking it, you see. All right. So again, the point of today's episode is I just want to show you what I would do if someone said, hey, what is a fair apples to apples way to rank, on the one hand, someone buying a whole life policy, and on the other hand, someone, quote, buying term and investing the difference. That's what we're exploring today. Now, let me make sure, I'm going to paraphrase what Dave said and distill it down to the essence. Let me just make sure everyone understands what it is that comparison means. So a whole life policy, as the name suggests, it's in force for your entire life, so long as you keep making the contractually owed premium payments. You're definitely getting the death benefit, you just don't know when. Also, at any given time, you can surrender the policy for what's called the cash surrender value. As a final feature, at any given time, the life insurance company is contractually obligated to make a loan to you at a specified policy loan interest rate, with the cash surrender value of the policy serving as the collateral. Okay? And so in a given policy over time, you can see the illustrations showing how the cash value rises. And what we're going to see with this particular policy we're going to consider for today's episode, the dividends that the policy generates, we're going to roll over and use to buy more what's called paid up additional life insurance. So it's sort of like one shot bursts of just saying, hey, if I give you $800 right now, how much additional whole life insurance does that get me? And that augments the original policy. And that's just illustrated by adding to the totals of both the elements, both the cash value and the death benefit. Okay, so in practice, for a policy designed this type of way, not only the cash value over time, but also the face death benefit is going to rise. Because again, each year, the dividends that this policy throws off, we're going to roll back into it to buy more paid up life insurance, which is why that face death benefit is going to keep marching up also. All right? So that's one way of doing it. Now, Dave Ramsey and people, according to his line of thinking, are going to come along and say, that's crazy. You're mixing two different things together. If you want to have death benefit coverage in force, go ahead. That's a good idea. Dave Ramsey's not opposed to life insurance. That's a responsible thing to do, especially if you're married and have kids. And it's also good to save for your retirement, to be, saving money, to be socking it away, putting it into financial assets. Dave Ramsey is also a fan of doing that. But he says you should optimize in each category separately. So go ahead, and if you need $1 million in death benefit coverage, in case you happen to die next week, to make sure that your family's taken care of, pay off the mortgage on the house and such, go ahead and do that. But shop around. Go find a cheap term policy to get that death benefit coverage in force. And then if you want to go and invest some money in the financial assets so that you can have a growing pool of wealth over time, go ahead and do that and go look for a good rate of return, he would say. All right? And he's saying the problem with using whole life to try to do both at the same time with the same vehicle is that you're getting a bad deal on both ends. That again, this is all what Dave Ramsey would say. I'm not endorsing this view, but he would say they're overcharging you in a sense for the death benefit coverage because you get a much cheaper term policy for the same face value. And the internal rate of return on the cash surrender value relative to the premium payments you have to make is appalling. For the same amount of cash you're pouring into one of these whole life policies, Dave Ramsey would say, take a little bit of that and go get yourself a term policy. And then with the savings, with the difference, go put that in a mutual fund or something. That's going to have a much higher rate of return than what you're getting on this cash value. And so he's saying you got the best of both worlds. And as a kicker, he'll say, if you happen to die while the term policy is in force, what do you get paid? You get paid the face death benefit, and your mutual fund balance is still there too for your estate or your heirs or whatever. So you get them both. Whereas if you have the whole life policy approach, if you happen to die, all you get, or the beneficiaries get, is the death benefit. They don't get the cash value also. And so Ramsey thinks that's just another way of showing how bad a financial asset these permanent cash value life products are. Okay, so that's the idea. So that type of glib analysis is completely misleading in my view. And so what we're going to do for the remainder of this episode is see why I'm saying that with such confidence. So for our purposes today, what I'm going to do is walk through some calculations I've made based on actual illustrations from a real world life insurance company. I had one of my colleagues at Infineo draw these up literally yesterday. So these are current, this is real world stuff. All right. So this is my calculations. I put them into Excel, as you'll be able to tell from the image that you're going to see, or the imagery, because I'll have multiple shots as we go through this. But these are all drawn from real world software that a home office generated. Okay. So the scenario I have in mind is a 25-year-old male non-smoker. It's what's called preferred, if you want to know that, if you understand that terminology. So in good health, non-smoker. And the scenario we have in mind is he's going to have $1 million in death benefit right out of the gate. Now, for the whole life policy, and I don't want to get too much into the weeds of this because this isn't so much about how do you construct these whole life policies, but for those who know, it is a 40-60 split between base premium and paid up addition rider. And also, in order for the policy not to become a modified endowment contract or a MEC, we've got a 10-year term rider put on the whole life policy that drops off after year 10. Okay, just to give a little inside baseball for people who understand some of those nuances. We fund the policy for 30 years, after which time we just use the dividends to go ahead and fund the rest of the premium. So the policy holder, cash out of pocket, after 30 years, stops funding it. Okay, so in practice, the way this works is it worked out to be about $15,000 a year is what you needed to get that initial $1 million in death benefit coverage. Okay, the first 10 years, there was also an extra 144 coming out of pocket for that term rider. Okay, so with this particular policy, funding it the way I've just said, we'll flash up here now. You can see the cash surrender value at the end of year 1, when the person's age 26, is $8,470. And the death benefit at that point is $1,020,320. Okay, so the reason it went up a little bit is the dividends are rolling over in this policy and buying some additional life insurance by the end of the period. All right, and then that just continues. So we'll check in like at year 10. Again, for 10 years in a row, the client's putting in $15,144 every year. At the end of year 10, when the client's 35, the cash value on this policy is $150,815. And the death benefit in force is about $1.5 million. So you see the death benefit has grown more than 50% of the original face value, just by the construction of the type of policy that we here at Infineo. This is the kind of thing we would recommend. Every policy is tailored to the individual client's circumstances, but this is the kind of thing we would typically do, something in this ballpark for a generic client. Like there's someone with this kind of cash flow, maybe it's like a small business owner, and they're funneling this amount of cash in, not only for the death benefit coverage, but also to have an asset there in case they need some financing for their business or whatever. This is a great asset to be bulking up. We'll talk maybe more about that in a minute. Okay, so that's how that works. We'll just jump way ahead. You'll see at year 30, when the client's 55, we do that last $15,000 premium payment. The cash value at this point has risen to $874,000, and the death benefit coverage in place is now $2.4 million. And then just one more, we'll scroll way down. I've taken this out to age 90, 65 years into the policy. You can see the cash value has grown to a whopping $4.1 million, and the death benefit is about $4.8 million. Okay. Now, what are we going to compare that with? All right, so that's a neat little thing, and we can talk about how one might use that and so forth, but Dave Ramsey is going to say, well, that's a silly thing to have. Instead of doing that, why don't you buy term and invest the difference? All right, now, there's different ways we could go ahead and approach that, but I think a fair comparison is to take a 30-year term policy and to say, okay, because this person, he's starting out at age 25 when he begins this process. And so you can see him realistically saying, I need to have at least $1 million of death benefit coverage for my spouse and kids for 30 years, right? That's pretty good. If at any point over the next 30 years, at that time horizon, if something were to happen to me and they get $1 million, that's adequate. That's taking care of them. I'm being responsible. All right. So that's what Ramsey's approach sets this person up with. Now, Dave Ramsey is right. It is a lot cheaper to get $1 million in death benefit coverage on this healthy, non-smoking, preferred rating 25-year-old for 30 years than it is to get a whole life policy. So the whole life policy was $15,000. The 30-year term premium is only $705. Okay, so if you're willing to put $705 in over a 30-year period, this same life insurance company for the same hypothetical individual will give you $1 million death benefit coverage over that entire span. Now, maybe it's a good point for me to stop right there and explain something. So right there, a lot of people might say, wow, that is a huge difference. That for the same death benefit coverage, starting out at least, on the one hand, you have to pay $705 for the term policy, where you have to pay a whopping $15,000 a year for the whole life. Why is it so expensive? Is that because the agent commissions are so big? No, the reason is, look at what you're getting. The term policy is only in effect for 30 years. If you live beyond that, all the money you pumped in is gone. Right? To use Dave Ramsey's approach, you could say, oh, they kept your cash value if you live beyond that. Or they kept your death benefit. If you died 35 years later, you get no death benefit. So that greedy insurance company kept my death benefit. That's why term policies are such a ripoff, right? I'm being facetious, of course, in case that's not obvious. Just the way these things are designed. Right? So that's why they can be so cheap, is because the life company knows for most people getting these term policies, the life insurance company is just going to collect premiums the whole time and not have to pay out. Occasionally they have to pay out, of course, but it's rare, and that's why they can be so cheap. In contrast, the whole life policy is in force the entire time. The insurance company knows, unless the person surrenders the policy, that death benefit payment is happening. They just don't know when. All right, now to give you an idea of how expensive these things can be, or what's driving the pure cost of it, I should perhaps say, if you just had a 10-year term policy, the price there would be $265, right, for the same company, right? So a 10-year term policy is $265, whereas the fixed level premium on a 30-year policy is $705. So why is that? Well, it's obviously because you're more likely to die the longer out that term goes. In fact, I can tell you specifically, because we can look at what the 1-year annual renewable rates would be from, again, the same life insurance company, same individual, same $1 million in death benefit coverage. For example, if you go out past age 55, right? So when that original 30-year term policy expires, that the premium was $707. Suppose that individual says, you know what? I kind of liked having that $1 million in death benefit coverage in force. Now that my 30-year term policy has expired, for which I was paying a quite affordable and reasonable, sorry, it's $705. I said $707 a minute ago. $705 a year. What do you need? And he talks to his agent that, is in Dave Ramsey's network of endorsed local providers and such, and says, yeah, actually, I kind of want to I like having that death benefit coverage. My wife feels good about it and everything. So I'd like to maintain my $1 million in death benefit coverage. How much would that cost me? It was $705 for the last 30 years. Now that I'm 55, I'm sure I'll go up a little bit now that I'm turning 56. How much? And they say, oh yeah, that'll be $10,275, right? Just for 1 year of coverage for him being now 56. The premium jumped from $705 to $10,275. Okay, so that should give you some idea of how rapidly the annual cost of pure death benefit coverage escalate. Why? Well, because obviously the mortality rates start rising very rapidly as a person gets into middle and later years. Okay, and so a life insurance policy, in a sense, is like, for someone who's 25, it's like a 95-ish year term policy, because these things are in force up through age 120 or 121 in the United States. In Canada, it's up through age 100. Right? So in the US, if you live to be 121, the life insurance on these whole life policies, they would actually just give you the quote death benefit, even though you were still alive. That's just the way these things are built. So they have to have a logical termination point so that they can go backwards and calculate what the cash values are along the way. Another way of saying it is, these things are designed such that the cash value rises to exactly meet the face death benefit at the completion point, which again is age 121 in the US and 100 in Canada. Okay, so Now you start to understand why the premium, the fixed level premium on the whole life policy was $15,000, because in a sense that was like, I say, like a 95-ish year term policy, if you want to think of it like that. So again, same company, if you only had a 10-year term policy, the premium was $265. When you expanded it out to a 30-year term policy, the premium jumped to $705. And then if going beyond that, just the annual, if you just had it rolling over each year, it was priced at what the current amount was, it would jump to $10,275 just to have that $1 million coverage in force for when the person's age 56. And if you wanted it when the person's 75 years old, just to have 1 year of term coverage of $1 million, the premium would be $64,365 just for that 1 year of coverage. All right. So what's happening, of course, is with the whole life policy, the insurance company, in a sense, is overcharging you on the front end to buy assets so that down the road, it's not having to charge you ridiculous amounts. Just like it's doing that with the term policy too, right? Early on, the $705 that it's collecting is more than it needs for the pure death benefit coverage at that point. Because as we've seen, if you just had a 10-year term policy, they would only be charging you $265. So there's a sense in which even with the 30-year term, early on, they're overcharging you, if that's the way you want to think of it. And then later on, they're undercharging you. And it all kind of balances out because of competition, right? They couldn't just overcharge you grossly the entire time. Otherwise, a competitor to this particular company would come along and offer more attractive premiums. Okay. So now we've talked a little bit just so you understand the big picture. So that 705, yes, it's a lot lower than 15,000, but now you've got a better intuition as to why that is. Okay. To continue the analysis though. So we want to do a head-to-head comparison with the same cash flows coming from the client. So we've already established that the first person who's following the whole life strategy is kicking in for the first 10 years, 15,144, and then it drops down to 15,000. So to keep it apples to apples, that's what we'll have the second person do, the same cash flows coming out of pocket. So 705 for the first 30 years has to go to maintaining this term policy. The remaining for the first 10 years, 14,439 goes into this side fund. And then later that drops to 14,295, just again to be apples to apples when the original person no longer has to pay that 144 for the term rider. Okay. And then after 30 years, this second person stops pumping in money altogether. The term policy expires, so there's no premium owed on that. And he stops contributing into this side fund. Because again, we just want to be consistent. The first person we assumed, it's not that the first whole life policy is contractually paid off. It's just the person stops kicking in money out of pocket. And we just had the internal dividends taking care of that. Okay. Now, here's where things are going to get controversial. This side fund, what should we assume that it grows at? Dave Ramsey is going to say, oh, go put it in a mutual fund that's tied to the stock market and have it, let's assume it grows at 11% annually. Because that's, like over the last 10 years, that's kind of where, and I think that's nuts. And you're stacking the deck. You're not appreciating what it is that you're getting with the whole life approach if you set it up that way. And here's why. If you're going to say it's crazy to buy a whole life policy because when you look at the growth in the internal rate of return on the cash surrender values, and that rate is a lot lower than what you could earn in a mutual fund that's all in stocks, that would be as relevant and as fair as saying nobody should ever buy bonds because you can make a higher rate of return in the long run if you invest in stocks. And in particular, all these institutional money managers who are invested in treasuries are fools. They apparently don't know that the stock market outperforms treasuries over, a long time frame. So that would be a goofy thing to say because obviously stocks are more volatile. They're riskier than bonds. All right. There's a different risk reward trade-off involved. It's not that one asset is right and the other one's wrong. It's just they have different attributes, different pros and cons. And it would be silly to just put all your chips in, I guess literally, on the higher expected rate of return of the stock market. Okay. Now, when we think through just how safe and dependable the cash surrender value on a whole life policy is, then we realize it'd be difficult to find another asset like that. So in particular, the cash surrender value of a whole life policy can only go up. It marches up over time. The dividends, just to be clear, are not guaranteed, but once they're paid, they can't be taken away. Okay, so what I mean by that is, in a given year, you're only guaranteed that the cash surrender value of your policy will go up by a fairly modest amount. But typically, on top of that, there's a surplus that then's distributed to you as a dividend, and that makes your cash value rise more. And so I'm saying, even though you can't ahead of time be guaranteed that dividend's coming in, once it is issued, you have a new plateau, a new floor on the cash value of your policy, that it can't go down once it's gone up because of a dividend payment. Now, when we wonder, well, how safe is that? Let me just point out, that is even safer than somebody who's investing in treasuries, particularly longer term treasuries. As Silicon Valley Bank, for example, discovered, even if you have your assets, your portfolio in, quote, the safest asset around, US treasuries, if they're long dated ones, then when interest rates rise, they suffer from interest rate risk. The market value of your bonds, of your treasuries, goes down when interest rates rise rapidly. And that's what happened to SVB and other institutions that got in trouble. In contrast, when interest rates rise, the cash surrender value of your whole life policy doesn't go down. Now, another twist is the growth inside your whole life policy, strictly speaking, in terms of compliance, advisors are supposed to say it's tax deferred, but if you handle it correctly, there is never tax liability due to that buildup, right? You can't say tax free to be compliant because there's things you could do in which case there would be tax liability, but so long as you handle it properly, that would never happen. Okay. And so, of course, people who are setting up policies in this fashion would be advised as to, here's what the rules are. Okay, so to be comparable, the side fund also really is what we're talking about is the after-tax rate of return on it to make it apples to apples. So for our purposes right now, I have assumed that the side fund grows not at 11%, but at 3.5%. And again, somebody who wants to beat up on me on this video is going to say, oh, that's way too low. Okay, that's fine. But again, the higher you make that number, the more you're making it an unrealistic, non-apples to apples comparison. That you're having the buy term and invest the difference client get into an asset that is riskier than the cash surrender value on the whole life policy. And no one denied that if you take on more risk, you can have higher expected rates of return. But that's not clearly outperforming the more conservative, dependable asset. Okay, so again, how I came up with that 3.5% is I was trying to say right now for the foreseeable, next 10, 20 years, what rate of return could somebody expect on assets that are extremely safe, that they never go down in value, they don't even suffer from interest rate risk, and this is the after-tax rate of return. So it's, you want to say like 1 year bank CDs, 3 months treasuries that you keep rolling over, and so they wouldn't have too much interest rate risk, or maybe 6 months, maybe even 1 year. And you could say, oh, but Bob, right now, short treasuries are yielding more than 3. Okay, but again, we're doing after tax. And also, I think most people don't believe T-bills are going to roll over for the next 30 years at their current rates, that this is an aberration due to the Fed tightening, and then they'll come down in the future. It's partly why the yield curve's inverted. Okay, so that's how I came up with that number. You want to quibble with it, fine, but you shouldn't, under any circumstance, be plugging in 8-9% if you're trying to make this an apples to apples comparison. Okay, so now having done that, let's just explore a little bit more. We can then look at the side fund that's growing for this second person in the analysis and the death benefit in force. And now another thing to consider. I think it's very appropriate because part of the difference in these two strategies is the person with the whole life policy is going to have a continually rising amount of death benefit coverage in force relative to the person with the term policy. Even during the first 30 years, as we've seen, the whole life holder goes from having actually a little bit more than $1 million to it grows, more than 50% early on. And by the time the other person term policy drops, the whole life policy has $2.4 million in death benefit coverage. Okay. So I want to be able to capture that in terms of a static number. So it would be wrong to say, oh, if you have $2 million in death benefit coverage, that's like having $2 million in the bank. That would be wrong. But you also shouldn't say that's like having zero in the bank. So how do we value it? I think a fair first approximation is to say, let's look at the mortality rate for this individual at that age and then multiply the two together. All right, so that's like the expectation or the expected value of having that death benefit coverage in place for that person for that year. All right, and so I grabbed specifically it's from the 2017 CSO mortality tables. That's the non-smoker preferred male A and B. If you're an insider and know what those terms mean, that's what I used for these calculations. And so that what we can do is for each year, look at what I'm calling the value of in-force death benefit coverage. So again, that takes the death benefit coverage that the person has multiplied by the mortality rate of that person's age at that moment. And I'm saying for that year, this is the value we're assigning to having that coverage in force. For example, just to give you an idea, like if somebody is part of your job, if like job A offered you a certain salary and job B offered you a different salary, but they also had as a benefit a company, life insurance plan with $1 million in death benefit coverage that you didn't actually have to pay for, that was just in place, that would be valuable. Okay. And so you could look and see like what are the premiums that they're implicitly paying on your behalf. That'd be one way of doing it, or another way is just to like directly, like I say, multiply this out and say, well, in any given year, there's a chance I'm going to die. Multiply that probability by the payout if that happens. And that's a rough first approximation to, how do we value this asset? Okay. And then you add up those two together. So for the second person, that's a straightforward calculation. You look at what's in that side fund that's rolling over at 3.5% with the annual contributions for the first 30 years. And you add that at any given time to the value of the death benefit coverage in force being the $1 million times whatever the mortality rate is for that year. And you get the total value of that package. With the whole life person, it's a little bit trickier because there's this issue about you lose the cash value when you die. So you don't just add those two columns together. It's a little bit, you do the probability that you're going to be alive times the cash surrender value, and then the probability that you're going to die times just the death benefit. And then you add those two together. And that's what the expected value of that package is in a given year. Okay, so just a little tweak. So my point is, I'm taking full account of Dave Ramsey's big, huge objection about when you die, you just get the death benefit if you have a whole life policy. So these numbers take into account that subtlety. Okay? And so then you can see year to year what the total value is of either package. And we know each year how much cash is being put in. By construction, it's the same. It's $15,144 for the first 10 years, and then they both switch to only pumping in $15,000. And so you can look at what's the annual rate of return on that $15,000 that you're putting in, plus with the continuation of the package. Okay, so I want to be clear. This is not the cumulative annualized rate of return. That's not what these numbers mean. We're saying year by year. I'm just looking at, take the last year's ending value as a given, then you pump in more money this year, then look at what's the value at the end of this year, and that percentage change is how much this year the package grew. Again, taking into account the fact that you had to pump money in, if you did. After year 30, they're not pumping any more money in. Okay? And if you do that, look at what we see. That, wow, early on, the whole life policy looks bad, doesn't it? That first year, it suffers a whopping negative 42% rate of return. And what does that mean? Well, it's because the total value of the package, the way I've computed it, is only $8,753 when you pumped in $15,144. So that's not a good rate of return, looked at it in that fashion. But then over time, it recovers rapidly, such that like by year 20, it's chugging along at 4.7% annual growth rates. And it hits up to 5.0 when the person's in his late 50s, early 60s. And then it peaks there, then drifts down a little bit. But even out to age 90 of the person, this package per se is still appreciating at an annual rate of 3.5%. And remember, that is effectively a tax-free rate of growth. Okay? In contrast, what's going on with the person who's buying term and investing the difference? Here's what its annual rates of return look like. So you can see early on, they're pretty anemic, and they start rising, and only after that 30 years do they finally start hitting 3.5%. So what's the intuition here? It's because there's a drag. Early on, you're overpaying for that term policy. All right, so just look at year one, for example. The person is paying $705 for a term policy that year is really only providing $280 worth of expected benefit, right? The mortality rate times the $1 million death benefit in force. Remember, we saw if you had just been charged lower premium, for a shorter term policy, then the premiums would be much closer to these numbers. Okay, so in a sense, what's happening even with the term policy, because the insurance company is overcharging on the front end, that's showing up as significant drag in the correctly calculated value of that package. Putting those two assets together of the term policy plus the side fund that's rolling over at 3.5%. So it's dragging on that fund over time, and it only finally gets up to the 3.5% when it's just the fund, right? Once it's free and clear and that term policy falls away, you've just got the fund rolling over at 3.5%, and that's why the annual rate of return is just a constant 3.5% from that point forward. Last little point I'll make here is notice at age 31, for the person who's buying term and investing the difference, the annual rate of return drops from 3.4 down to 3 for 1 year, and then it jumps back up to 3.5. Why is that? Because their $1 million in death benefit coverage disappeared as that term policy expired. And so that's it's showing up in that fashion, that there was a value to having it. Specifically, you can see as of when the person was age 55, 30 years into it, the value of that $1 million in death benefit coverage was $3,360. And then that aspect of the package goes to zero the next year. Okay. Now, we can look at various things along the way to try to determine, okay, so which one of these is better? Well, it depends what the client wants to do. And so here, again, my point is not to say one is better and the other's awful. I just want people, though, to be able to understand the different attributes of these two approaches. And there's pros and cons. Okay, so the cash surrender value of the whole life policy, let's say as of year 10, so when the person's 35, is $150,815, and he's got $1.5 million of death benefit. The side fund of the person buying term invested difference is $175,000, so a little bit higher, but he's only got $1 million of death benefit coverage. And then if we go down more, what happens by year 20, the cash value in the whole life approach is $426,000, whereas the side fund in the buy term invested difference is only $421,000. And the death benefit, the first way, gives you $1.8 million against $1 million of the buy term invested difference. Now, if you jump way out, let's go all the way to age 90, the cash value is $4.1 million on the whole life plan, whereas the side fund, believe it or not, is only $2.5 million, or 2.6 with rounding, on the buy term invested difference side. And the death benefit coverage is $4.8 million, the whole life approach, and it's zero with the buy term invested difference. So here we can collapse the views and show you a different thing, what I'm calling the whole life edge if alive, and the whole life edge if the person dies. Okay, so again, at any given year, we can say, what if the person is alive for this whole year? What would they have to their name under either approach? And then what if the person dies in that year? What does the person have to his name under either strategy? All right, so for example, if we go out to year 10, if the person is alive at that point, then the whole life edge is actually negative $24,000, right? If you knew for sure you were going to live for the first 10 years, and that, you just checked in at that point, yes, you would have more in that side fund than you would have in your cash surrender value, and that's all that matters because you're still alive. But if you happen to die at age 35 when you're 10 years into it, the whole life edge is $329,000. And that's because the death benefit under the whole life plan is a certain amount, and that is $329,000 more than the $1 million term death benefit, plus even what the side fund is, because if you die under the buy term invested difference, you get both. So even accounting for that, still you're ahead $329,000 the whole life. And you can see the entire span, if you die at any point, you would have wished you had the whole life approach. That's true for the entire period of analysis. But what may surprise you is even if you stay alive under this approach, the way I've conducted this analysis, by year 20, when the person turns age 45, even if you're still alive, as of that year, the whole life policy now becomes better, right? And that you can see it, that the whole life edge finally goes from being negative to flipping to being positive. So specifically in that year, the whole life cash surrender value is $425,000, $657, whereas the side fund, its value was only $420,800 and change. Okay, so the cash surrender value has surpassed that side fund, and of course the death benefit is way bigger. And then that advantage in either approach, whether you're living or dead, just keeps growing for the whole life strategy for the rest of the period of analysis, such that as of when the person's age 90, if we knew for sure he'd still be alive, he would have an excess of $1.56 million in liquid funds, right? The cash value would be that much higher than the value of that mutual or that side fund. And if he died, he would have $2.2 million more, because that's what the death benefit would be at that point, over and above the value of that side fund, because there's no death benefit at that point for the person who bought term and invested the difference. Okay? So to say which approach is better, strictly speaking, it depends what happens. And it depends when you ask and what the period of analysis is. That there's a sense in which the person 10 years into it, if he really needed liquid funds, might say, I wish I had bought term and invested the difference because that side fund right now would be worth more if I really need cash than what this cash surrender value is in the whole life policy. If at any point the person dies, then the widow is going to say, I'm glad we had that whole life plan because this death benefit check is bigger than what we would have had if the person had followed Dave Ramsey's advice. Right? So that, again, that's true at any point up through age 90. Now, let me close with just one last consideration. I can imagine some viewers understandably objecting and saying, wait a minute, Murphy. We understood how in the beginning you said, yeah, right out of the gate, to be apples to apples, you assumed a 3.5% after-tax rate of return on, what you call the side fund in your analysis. Fair enough. Okay. We agree to just assume you put everything in the stock market, and especially to assume it consistently earns 11%. That's crazy. That's not relevant to anybody. However, they could say, isn't it more realistic? Isn't it a fair comparison for the person who's buying term and investing the difference after, say, 10 years of plowing the 15,000 less the 705 for the term premium, after say 10 years of doing that, then switching to something that's more aggressive. That's a bit riskier, but not crazy. So specifically, just look on these numbers, the value of that side fund 10 years into it when the person's age 35 is $175,000. So surely at that point, this couple or this family, whatever, could say, all right, that is pretty safe money. Let's leave that 175 grand rolling over at the three, in these assets that are earning, we assume 3.5% after tax. And now going forward, let's start plowing the 14,295 for the next 20 years where we're still going to be, funding. Let's put that into something more aggressive. It doesn't have to be tech stocks, but surely, a broad S&P 500 index, something like that. But we can afford to be a little bit more aggressive now that we've got 175 grand in pretty safe assets that we can just put over here to the side. Right? So sure, that's perfectly reasonable. I'm not insisting that, they got to just keep putting it in. But by the same token, the person who's doing the whole life approach, we at Infineo and the other people in this community who believe in using these policies to help people manage their cash, the point isn't to, quote, invest in life insurance and just let it sit there. No, part of the point is you have access to your wealth and you don't have to wait till you're age 59 and a half. The way that is true if you follow Ramsey's advice and use tax qualified plans, for example. All right, so the whole life plan at that same age has $150,000 in cash surrender value. And so if you see a good investment that you want, you can borrow against it and go put it in that vehicle. All right. Or, later on, after you funded things, as of age 56, 31 years into it, the cash surrender value in that whole life policy is $918,000. And for the next several years, the growth on that is 5%. Or then later on, it drops down to 4.9. Now, that's the growth on, counting the package of the enforced death benefit coverage. So that's not the exact same thing as what the cash surrender value is growing at. But still, you're getting high. So my point being, that's in the same ballpark as what the policy loan interest rate would be for this whole life policy. Right? There's no reason they have to mathematically balance all the time, but I'm saying the same ballpark the deeper you get into this thing. And so it doesn't tie your hands. You could borrow against that and then go deploy your funds if you want to, So for example, if you want to take 300,000 and go put it in the S&P 500, you're allowed to do that with this approach. You could borrow 300,000 and go put it into the S&P 500, or go put it into gold, or go put it into Bitcoin, or whatever you want to do. You see some good commercial real estate venture, go ahead and do that. Okay, so the point here is, though, that what this asset gives you is very liquid, dependable funds. That's like the headquarters for your cash, that you go seize an opportunity, and then if that unwinds or completes, you put your cash back into this by paying down the policy loan, for example. Okay, so that's the mentality here. It's not that you're, quote, investing in whole life. It's that this is a very good infrastructure or chassis for your broader plan. And so that's the analog of somebody who, when they're buying term and investing the difference, after they fund a very safe vehicle to bulk up and get 150,000 plus in very liquid, quote, cash to be sitting there, then beyond that, they start getting into more aggressive things. Yeah, you can mimic that with the whole life side as well. All right, so that's, to me, the way you would analyze these things. And so we've seen that once you do an apples to apples comparison and take into account some of the obvious considerations that are surely relevant, right? For me to be going through and saying, hey, if at any point you die, clearly, hands down, your beneficiaries are going to be glad you did the whole life approach with the particular strategy there I showed. That's not surprising, right? Because you're getting a lot more life insurance, right? Nobody's denying that the first strategy involves buying a lot more life insurance. And so it's not weird to say in scenarios where you die early, bulking up on life insurance turns out to be a great financial move. Okay, but my point is, it's not only good in those circumstances. As we've seen, depending on the assumptions we make, there was a crossover point at which, even if you were still alive at those various years, you would have had more liquid funds at your disposal doing the whole life approach. Okay, so we will wrap it up there. Thank you, everybody, for your attention. I know this was some deep stuff, but there's a lot of misinformation. And again, my point here is not to tell you one way is better than the other. Rather, I'm trying to give a framework to understand how would you fairly and adequately assess either buying a whole life policy or, quote, buying term and investing the difference. Thanks, everybody, and we'll see you next time.
This concludes another episode of InFi, the Future of Finance, with Dr. Robert Murphy. The information provided is for educational purposes and does not constitute financial advice. Consult with qualified professionals before making any financial or investment decisions. For more information on the host and for previous episodes, visit infi, thefutureoffinance.io. Thanks for listening.